I think on our side, if I look at the investment returns to September 2018 relative to September 2017, investment returns have come down by half, or 50%, which is really a reflection of the difficult operating environment that we're in. So in 2017, we had just come off the back of a hotly contested election. Remember, we had 2 elections in the space of 3 months. We were also grappling with a drought at the time. So there was a lot of, in my view, pent-up momentum and pent-up demand. A lot of people are very expectant of a strong 2018 and some level of a recovery. And I think to a large extent the markets were primed for that. If you look at the one large piece of legislation that everybody was looking at, which was interest rate capping, there was a lot of hope and belief that in January these caps would be lifted by June of 2018. And a lot of investors had begun to buy into listed equities, particularly the banking sector, in anticipation of the lifting of the interest rate caps. But I think what then happened in 2018 is that we then got a different outcome. In 2018, we have not seen the lifting of the interest rate caps. In fact, we have realized these caps look to be fairly enduring, to be honest. We also then realized that from a fiscal perspective, there was no fiscal consolidation that then happened. In fact, we then saw the level of externalization of debt continue to increase through more sovereign bonds and so on and so forth. And from a fiscal perspective, more government spending, particularly on large-scale infrastructure projects. So all of that then has put a lot of pressure on the economy, has put a lot of pressure on obviously the debt load that the current country is currently carrying. And with the current assessment, particularly from some of our stakeholders, that our currency is now fairly actively managed, it appears to be overvalued. That has been seen to be a sign of risk by many international investors. And if you do look at our stock market as an example, 50% of our flows, perhaps even more, I believe the number is closer to 60 or 70%, comes from foreign investors. These are investors from the US or Europe who are managing long-only sort of equity funds, hedge funds, and so on and so forth. So a lot of them now have pulled away from the Kenyan stock market. In fact, the Kenyan stock market is now more on offer rather than on bid. And a lot of them are pulling back because there's an anticipation that the currency is soon going to have to correct. And for them, they do feel that if the currency corrects, they obviously earn less returns in dollars. And from a debt perspective, it then makes the current debt load that we then have more expensive from the point of view of debt servicing and so on and so forth. So I think that all that has then weighed in on the investment markets. And obviously with a correction in the currency, people then expect interest rates to then start to correct upwards. So it does appear that the investment markets and the capital markets are reflecting in advance some of the pain that we expected to feel, perhaps from this moment going forward for the next maybe 12 to 18 months. So that is, in my view, really cause and effect, and really begins to explain why investment returns have come down by half in the 12 months to September 2018 relative to the prior period. My sense is that whilst the handshake was good for stability, it's barely had any impact, on my view, on the economy. In fact, even worse, it has really just heralded the starting of almost political campaigns heading into 2022. So in my view, it has somehow accelerated that to a large extent. So I think the dividend that we all expected into the economy in terms of stability and so on and so forth has been spent, and we've already kind of received that. What worries me to a large extent is that the government appears to be spending more than it is receiving in revenue, because we're now receiving about 1.4 trillion, maybe at best 1.5 trillion worth of tax revenue every year, but we are paying out at least 830 billion shillings a year in terms of debt payments, so both principal and interest payments. If you then look at the pension bill, that's approximately another maybe 150 million. That already takes you to ₦1 trillion. If you look at recurrent expenditure, that's at least 1.5 trillion shillings. So the revenue that you have then received from the Revenue Authority is now exhausted. You're yet to then obviously contribute into the County Equalization Fund to then fund county activities. You have not even begun to remember that you have a development budget to then fund. Hence the external borrowing that the government is then doing. So a lot of that information, I think, was deciphered by investors in 2018. And as I said earlier, I think a lot of investors had put a lot of what turned out to be false hope in the legislative process around doing away with the interest rate caps. So I think there was a gamble on that, which has not come to pass. And if you then add on the potential imbalance in the currency and interest rates, it just doesn't look good for the economy. So whilst the handshake was good from the point of view of signaling that Kenya is a stable country, and I think that has been positive, because if you do look at, as an example, the World Bank doing business rankings, Kenya has advanced several ranks up. Yeah. So if you do look at stability, enforceability of contracts, if you do look at the strength of the judicial system, Kenya is seen to be up there. The length of time it takes to open up and register a business, tax efficiency, we are doing fairly well. But from the point of view of productivity, which is where it really matters, I think that is where we appear to be challenged. And to a large extent, the government is well aware of that. Hence, His Excellency Uhuru Kenyatta's Big Four agenda, because really those are the 4 pillars that are required to drive a productive economy going forward, particularly in Kenya. So manufacturing, health, affordable housing, and so on and so forth. Those are seen to be the areas that will then power sort of Kenya's economy going forward. For a long time, we've been talking of twin deficits, a fiscal deficit and also a trade deficit. And I think we have the power within our means to then address both issues. In terms of the fiscal deficit, begin to consolidate the spend and prioritize the spend to then get the biggest bang for your buck. But from the point of view of the trade deficit, start to encourage more exports to narrow down this trade deficit. Because for Kenya, for a long time, growth has meant growth in imports. So when you're then doing well, banks are then lending, people then borrow money, people buy furniture, more cars, and they go on holiday. But we also want to say that you also need to fire up the export engine, get more productive, get into manufacturing, increase your agricultural exports, and so on and so forth. That is how you then obviously begin to strengthen the economy. So the heart is in the right place, but in terms of implementation, I think that is in various stages of success. I see it benefiting the capital markets because it is estimated that the housing fund will generate contributions in excess of 45 billion shillings a year. I think it is 50 billion shillings a year. That is extremely significant because the NSSF only contributes, I believe it is 30 to 40% of that number annually. So immediately you have a very large fund, and this is a fund that then needs to be committed towards investment. So this is a fund that needs to then have an investment strategy and an investment plan, because as it gathers liabilities, these liabilities need to be committed to assets to meet the promised return. So treasury bills, treasury bonds, corporate bonds, listed equities, that is where a lot of this money will be committed into. You'll also find that from the point of view of the affordable housing program, this is also going to be the fund that will act to stabilize the rental income that is going to support the tenant purchase schemes. So in my view, it is important that the fund is well managed. It is put into the hands of professional asset managers or fund managers so that a stable return can be generated to help offset any deficit that may come through from these tenant purchase schemes. And remember, the tenant purchase schemes are the exit mechanism for the homeowners who will then qualify under the affordable housing program. So in my view, it will have a very strong impact on the economy, and that together with the new legislation that we expect to come through for the NSSF will mean that there will be demand for many of these potentially privatized assets that we were talking about before. So I don't think one should worry. There are huge pools of domestic capital that are coming, but I think they have a home from the point of view of an investment destination. Britam Asset Managers, I think, is very well poised to take advantage of those opportunities. I think we are very well positioned because we belong to a diversified financial services group. So we don't describe ourselves as an insurance group. We describe ourselves as a diversified financial services group. That then means that Britam as a group has got appetite for investments and asset classes that perhaps others may not. So as an example, things like private equity, things to do with infrastructure. So we are quite keen to ensure that for all the liabilities that we have, both from the point of view of pension, the life business and the general business, we can then deploy them into long-term and stable assets that can help obviously meet the promised rate of return. So Britam is doing a lot in those areas from the point of view of A, policy and legislation, B, from the point of view of advocacy, and C, from the point of view of actual investment. And I believe in December or perhaps January, we will make a press announcement with our first, what I'd call landmark investment into infrastructure, a fairly large one. And then subsequently after, a landmark investment into private equity. So as Britam, we feel that we are fairly keen on these asset classes. We see them as fitting our asset liability matching mandate and framework. And we want to be seen as, as one of the market leaders when it then comes to this area. So Britam Asset Managers, then belonging to such a group, then has been able to find the requisite flexibility, the requisite philosophy, and also the mandate to also direct, third-party investments towards these asset classes. So we do feel fairly energized as Britam when we then come to consider some of those alternative asset classes.